And markets are rising in a technology-led bounce following blowout earnings from the juggernaut of the quarter of the year. That certainly is Nvidia. Right now, as you can see, the S&P is higher, Dow, NASDAQ as well. So let's focus on Nvidia. The stock beat expectations with earnings per share. It came in at 68 cents versus the expectation of 64 cents. Revenue of $30 billion in the quarter, beating expectations of $28.2 billion. Now, all of this amid growing demand for its next-gen chip. But the market was far from impressed, and investors began selling. So let's take a look at Nvidia's earnings history. The beats on a percentage basis have been declining in each of the last 3 quarters. Yet it remains the most influential stock in the market right now. And joining me now, Crossmark Global Investments Chief Market Strategist Victoria Fernandez. Victoria, what's your take on all of this and really market reaction to the numbers?
Well, look, everyone was waiting on the Nvidia numbers. They really are the bellwether for what we're seeing in this market. And they were expecting another blowout quarter. Nvidia reported good results. It just wasn't the blowout that people were expecting. But look, can a company grow at 500, 400% quarter after quarter? No. So I think they were good numbers. I think people still have confidence in Nvidia and the AI secular growth theme that's out there. But we want that broadening in the market in order to really have a sustainable rally here. And we're seeing that in some of the names, some of the Russell 2000 areas. We'll see if that continues.
Well, no, we're going to get into that later on in the show. But, you know, if you look at the last 4 quarters, including this one from last night, you know, initially it was a 31% revenue beat. Then it goes down to 19%, then 11%. This was over 9%. And I think that because AI and Nvidia is powering so much of the sector, that I can understand why there's a little bit of nerves. Look, let's talk about the labor market.
Yes.
You are watching the labor market. Falling savings rate, growth concerns in the stock market, indicators for the economy. So what is your outlook on a recession here? Because you don't hear a lot of that talk, but you cite this comments from JP Morgan about the labor market. And they say it's an odd combination of rising concerns about a U.S. slide into recession alongside financial market optimism. So where are we here?
It's an interesting combination because you do see these elements out in the market that are telling you we should probably be a little bit cautious as to what we're seeing. We're seeing quits rate start to come down, wages stagnating, the amount of jobs being lost going higher, and we're seeing the hiring rate. You look at the first 7 months of this year, Cheryl, hiring is down 45% from the first 7 months of last year. So that's coming down, and we know wages drives consumption. So if jobs are coming down, we think you're going to start to get this negative feedback loop to consumers not buying as much. That hurts revenues. That's going to hurt margins. Then you get more layoffs. You really get this feedback loop happening. This is what we need to be cautious of because a lot of things are telling us the labor market is weakening.
Then explain to me the consumer confidence number. I don't understand that. And also, you know, initial jobless claims today, you know, pretty much coming in line with expectations. So if we're not saying the initial jobless claims or even the continuing claims show us anything, I guess the next shoe that could drop would be the jobs report next Friday.
That could be it. We're actually going to be watching the JOLTS numbers. They come out on Wednesday, 2 days before that. To us, that gives you a better look. It gives you the hiring rates. It gives you the quits rates. That's kind of underneath the hood of the non-farm payrolls number. We think that's going to give you better clues. That is telling us things should be slowing down. And yes, consumers are spending, but they're spending out of savings. Credit card balances are going up. Credit card delinquencies and auto loan delinquencies are all going higher. So it's starting to churn a little bit. And I think it's why Powell said they're paying much more attention now to the labor market than to the inflation component.
Well, you had I think it was Breeze Airways CEO, if I'm not mistaken, that said that they're starting to see passenger demand go down, and some of the other airlines in their numbers.
And in retail too.
Yeah,
we're seeing
retail
it there.
too. Yeah, all right. So real quick, short-term investments, long-term investments.
Right.
What's your advice here for folks?
So for long-term investments, look, we want you to be invested in stocks. You want to have that exposure to the stock market for the long term, but you need to be tactical right now because of some of these yellow flags that we see to be cautious. We say put a little defensive into your portfolio. Add some staples, some of those large cap staples, a Walmart, a Coca-Cola, a Colgate.
That's your defense?
Yes, that's kind of the defensive component. Financials are doing really well, and as the yield curve starts to steepen again, you know that's usually a sign of the end of that cycle. Financials can work well as two. Utilities have done well. Healthcare is an area you can put some money to work. You can still have exposure to the tech and the other areas that are high growth that people like, but trim them down and put a little defensive play, add a little fixed income into your portfolio and some income generating equity components like covered calls.
Is the Magnificent Seven going to be the Magnificent One or Two at the end of this year?
It's already going there, right? I think we're down to
feels like
5 right now. We'll see how much lower we go.
All right, Victoria, thank you for being here on set. Appreciate it.
My pleasure.
All right.